Hello everybody, we're about to delve into an interesting topic today, stocks versus cryptos. In the world of investing, these two asset classes have been making waves, each with its unique appeal. Our mission? To shed light on their differences, similarities, and potential impact on your financial journey. Whether you're a seasoned investor or a curious beginner, this exploration will broaden your perspective. Remember, we are not financial advisors, and this video is for informational purposes only. Always do your own research. So, what exactly are stocks and cryptos? Let's start from the basics. First up, stocks. Imagine if you could own a piece of your favorite company. Well, that's what stocks are. Small slices of ownership in a corporation. When you buy a stock, you're essentially buying a share of that company's earnings and assets. As the company grows and makes profits, the value of your stock can increase. And if the company decides to distribute part of its earnings to shareholders, you get a dividend. A little thank you for your investment. Now let's switch gears and talk about cryptos, short for cryptocurrencies. Picture a type of digital or virtual currency that uses cryptography for security. It's like having a super secure digital wallet. No physical coins, no paper bills, just coded data. The most well-known is Bitcoin, but there are many others out there known as altcoins. Unlike traditional currencies issued by governments, cryptocurrencies are decentralized and operate on technology called blockchain. You can invest in both stocks and cryptos. For stocks, you'll need to open a brokerage account, and for cryptos, you'll need a digital wallet. It's important to remember though that investing always comes with risks. No one can predict with certainty what will happen in the markets. Now that we have a basic understanding of both, let's start comparing them. When it comes to investing, risk is a significant factor to consider. As we dive into the world of stocks and cryptocurrencies, it's crucial to understand the potential risks associated with both. So let's start with stocks. Stocks are shares in a company, and their value is closely tied to the company's performance and economic indicators. While the stock market has its ups and downs, it has historically shown a trend of growth over the long term. However, it's not without its risks. Market volatility, economic downturns, and poor company performance can all affect stock prices. Therefore, investing in stocks requires careful research and a keen understanding of market trends. Now let's turn our attention to cryptocurrencies. Cryptocurrencies are digital or virtual currencies that use cryptography for security. The crypto market is known for its high volatility. Prices can skyrocket and plummet within a short period, often influenced by factors like market sentiment, regulatory news, technological advancements, and macroeconomic trends. This volatility can lead to significant gains, but it also carries the potential for substantial losses. Unlike the stock market, the crypto market operates 24/7, meaning prices can change dramatically at any time of the day or night. Furthermore, the relative novelty and lack of regulation of the crypto market contribute to its riskiness. While some see cryptocurrencies as the future of finance, others view them as highly speculative assets. So how does one navigate these risks? Well, a diversified portfolio can help. By spreading your investments across various asset classes, you can potentially reduce the impact of a single asset's poor performance on your overall portfolio. Moreover, it's essential to keep in mind that investing isn't about making quick money. It's about building wealth over time. Therefore, understanding your risk tolerance and investing accordingly is vital. If you're someone who can stomach significant swings in asset values, cryptos might be for you. However, if you prefer a more steady growth trajectory, stocks might be your cup of tea. Risk is inherent in any investment, but the levels vary significantly between stocks and cryptos. So, as you venture into investing, remember to do your research and consider the potential risks alongside the potential rewards. Next up, we have the potential return on investment, a key consideration for any investor. When we talk about return on investment or ROI, we're referring to the potential profit or loss made from an investment relative to the initial investment's cost. It's a crucial metric used to gauge the likelihood of gaining a profit from an investment. In the realm of stocks, the return on investment can be steady, but the gains are often slower. Investing in stocks is like running a marathon. It's a long-term game where patience pays off. You buy shares in a company, and over time, as the company grows and becomes more profitable, so does your investment. Dividends, which are a portion of the company's profits distributed to shareholders, can also contribute to the ROI. However, the growth can be slow, and it often takes years for investors to see substantial returns. On the other hand, cryptocurrencies, with their notorious volatility, can bring about high return potential. Cryptocurrencies are more like a sprint. The prices can skyrocket in a short period, leading to substantial returns. Bitcoin, the most well-known cryptocurrency, has seen its value increase exponentially over the years, turning early investors into millionaires. However, it's essential to note that the same volatility that allows for high returns can also lead to significant losses. The value of cryptocurrencies can plummet just as quickly as it rises. The difference in ROI between stocks and cryptocurrencies can be likened to the difference between a slow and steady tortoise and a fast but unpredictable hare. Stocks, like the tortoise, provide slow but steady gains over a long period, while cryptocurrencies, like the hare, can lead to massive profits or losses in a short time. So, when considering your potential return on investment, it's important to weigh the potential gains against your risk tolerance. Do you prefer the slow and steady approach of stocks, or are you willing to take on the risk and volatility of cryptocurrencies for the chance of higher returns? While cryptos may offer high returns, remember the risks are equivalently high. Let's talk about liquidity, the ease with which an asset can be converted into cash. When we talk about stocks and cryptos, liquidity is a key factor. It's like the lifeblood of any financial market. The more liquid an asset, the quicker you can buy or sell it without affecting its price. In the world of stocks, liquidity is usually high. This is because stock markets have been around for centuries and are well established. There are a huge number of buyers and sellers, and transactions can be completed almost instantly during trading hours. So if you own shares in a company and you want to sell them, you can usually do so with a few clicks of a button, as long as the stock market is open. Cryptocurrencies, on the other hand, have a different story. The crypto market is relatively young and its liquidity can vary widely. For popular cryptocurrencies like Bitcoin or Ethereum, liquidity is pretty high. There are many buyers and sellers, and transactions can typically be executed 24/7. But when it comes to less popular or newer cryptos, liquidity can be a significant issue. The number of buyers might be limited, and if you want to sell, you might have to lower your price significantly to attract a buyer. In extreme cases, you might not be able to sell at all if there are no interested buyers. That's not to say that stocks are always more liquid than cryptos, or vice versa. There are illiquid stocks and highly liquid cryptos. The key point is that liquidity can greatly impact how quickly and easily you can convert your investment into cash. So, whether you're considering investing in stocks or cryptos, it's important to research and understand the liquidity of your chosen asset. You never know when you might need to cash out quickly, and the last thing you want is to be stuck with an investment you can't sell. Liquidity is a crucial factor to consider, especially if you might need to cash out your investment quickly. So, we've discussed risk, return, and liquidity of stocks and cryptos, but what does all this mean for you? Let's take a quick trip down memory lane. We started our journey by defining stocks and cryptos. Stocks, essentially shares in a company, offer you a piece of the profit pie as the company grows. On the other hand, cryptos, digital or virtual currencies, leverage blockchain technology for decentralization, transparency, and immutability. Next, we delved into the risk factor. We established that both stocks and cryptos come with their unique risks. Stocks are vulnerable to market volatility and company performance, while cryptos face regulatory risks, technological vulnerabilities, and extreme price fluctuations. Then we discussed the potential returns. Stocks have a long history of providing steady, albeit slower returns. Cryptos, while relatively new, have shown the potential for explosive growth, yet they can also plummet just as fast. Liquidity was another important topic we covered. Stocks, being traded on regulated exchanges, tend to offer greater liquidity than most cryptos. However, some cryptocurrencies like Bitcoin and Ethereum have gained significant liquidity over time. But what does all this mean for you? Well, it boils down to your financial goals, risk tolerance, and investment horizon. If you're looking for steady growth and can stomach moderate risk, stocks might be your cup of tea. But if you're game for high risk with the potential for high returns, and have the patience to weather the storm of volatility, cryptos might pique your interest. Just remember, there's no one-size-fits-all in investing. Both stocks and cryptos have their pros and cons. The key is to diversify your portfolio, balance your investment, and most importantly, do your own research. Thanks for watching. Remember, investing is a personal journey. Do your research, understand your risk tolerance, and make informed decisions. Don't forget to like, comment, and subscribe. And hit the bell notification so you'll get updates anytime we upload a new video.